Test, test. Hey guys, welcome. Somehow I screwed up there and cut out the initial intro video. Josh, can you hear me, my friend?
I can hear you. You hear me?
I can. We take 2 weeks off and completely forgot how to run this show. The band.
Technology. It's hard.
I know. The band is back together. So Josh, for those of you who don't know, Josh had a little leave of absence. He took a little break to have some surgery done, and 3 weeks ago, 4 weeks ago now.
4 weeks ago Monday, and finally feeling semi decent.
All right, so he's back, and as you guys know, we're here to answer your questions, right? Real estate related, mortgage related, housing market related, whatever your questions are, put them in the comments, and we'll do our best to address them. As always, we appreciate you guys watching. If you find value in the content, hit the thumbs up, share it with anybody you might know that might be looking at buying a house or have housing related questions. And as always, we're gonna talk about interest rates. We're gonna talk about predictions for interest rates and all that good stuff as we get into the show a little bit. It's usually a pretty common question. So, the more people are on here, we'll probably do it then so we don't have to answer it a bunch of times. But Josh, welcome. Anything you want to throw out there initially before we start going at these questions?
No. What's the ancient Chinese proverb or curse? May you live in interesting times. So we're living in interesting times. So it's a little stressful for us on the professional side, and obviously stressful for all of you on the buyer / homeowner side. So interesting times and a lot of stress. But we'll remember that if we're doing home loans, if we're selling homes, and if we're buying and financing homes, we're in a good position. So try to not be too stressed and unhappy.
No, absolutely. And for those of you who have reached out to me asking me about videos and that sort of thing and the consistency, it's kind of dropped off a little bit. It's just, honestly, I feel like I'm constantly talking about the same thing over and over again. I tell Josh, it's like I'm constantly, regurgitating the same information. And for those of you who constantly show support and follow me and subscribe and all that good stuff, I just, I hate talking about the same thing over and over and over again to you. I want to provide useful information. So with that said, if there's something you want me to cover, leave it in the comments below as well. We can do that. Interesting questions make for interesting videos. And typically speaking, if you have that question, somebody else does too. So if there's a way to help multiple people, that will, help us all, if you will. So let's start. Your boy Joey Crack is here tonight. Josh, I think he missed a week or two while you were gone. He took a little hiatus.
Yeah, well, he and I had a long talk about an hour, about a week ago. We went through, he pulled out all of his spreadsheets, showed me all of his analysis, and we're in a good spot. So he's ready to get out and tackle the upstate New York housing market here.
There we go. Awesome. And for those of you who don't know who are in California, Surf City HB in the chat there, ask about open houses. Those are allowed now. So started the pandemic, open houses were put on hold. We weren't allowed to do them at all. Every showing had to be appointment only. That is now opened up here in the state of California. So open houses can now commence again. I don't know. I think, that's going to add some fuel to the fire now, right? You're going to have more buyers out there, showing up to open houses and, but you need supply, right? And locally, we're not seeing a lot of it. But Joey mentioned seeing a little bit of supply there in the New York market. But anyway, let's dive into to some questions here. Matt, the mortgage guy, also said that he thinks that more supply will result in more supply. So for those of you that have seen my videos and or maybe haven't and don't know what I'm talking about there, what Matt's talking about there is, I think as you see more supply come on the market, you'll see exponentially more supply. And what I mean is that you've got a lot of sellers who are also buyers sitting on the sidelines who want to buy a property, but they just look at the market and they see nothing out there that fits what they're looking for, anything close to what they're looking for. And therefore they're not willing to put their homes on the market and play that contingency game of trying to find a replacement home. And if they do sell it, what do they do and all that. So I think as you see more homes come on the market, you're going to see sellers also go, you know what, that now might be the time because I'm starting to see more property that kind of looks like something I'd be interested in. And you might see that supply jump a little bit quicker just because of that, because I know there's a lot of people out there that want to do something. They can't find the right home. All right. So Gilbert George, seriously thinking about investing in Newport. What do you think? Should I wait? So, Josh, we tackle this question all the time. Investing is now a good time to invest in real estate.
Newport, Rhode Island, Newport Beach, California.
I'm thinking Newport Beach, probably local. Okay. Yeah. So just in general, though, let's just talk. Let's not say Newport, and let's talk about just investing in property. You're buying a property right now.
Yep. So we talked a few weeks ago, and if all of you experience, we all as buyers and every side of the market experience difficulties. So we've had that thing under contract. 6-8 weeks ago, I first talked about it. Sellers just signed their documents tonight. I'm signing my documents tomorrow. We'll close later this week, and that's a good place to start, just in terms of what do I actually believe. It's one thing to say, hey, here's my theory or my philosophy. The other thing is, where's your money actually going? So we're going to close Friday or Monday on that property. It needs a complete and total rehab, and the plan is to hold it for a minimum of 1 year, because I'm quite confident the values will be higher next summer than they're going to be this summer, which we know is an absurd number. Now, I don't, by any stretch of the imagination, we saw the numbers. Some areas are up 20%. Everything's double digits nationwide. I have no delusions that that's going to happen, but it's a $750,000 property. A 4 or 5% increase is another $30,000 or $40,000 year over year, which I think is a perfectly reasonable expectation. We'll get into rates later. Rates are going to stay low. We have a 13-year history of underbuilding. If you look at the charts of homes that were built relative to household formations, it wasn't a surprise that even on top of all of the horrible lending we had in 2005, 2006, 2007, that we had a crash, because we had overbuilt through that timeline. There were more homes being built and added to supply than there were household formations. So we're on the flip side of that. Way more household formations than homes being built. It's an epidemic, and it's not one that can get turned around quickly. On top of that, we got the supply chain issues that are making the cost of building homes really expensive. So especially on the low end, a lot of you guys are like, hey, I don't need $1 million home. I'm a first-time buyer. I want a $350,000 home. Well, the one thing that builders are really putting the pause to right now is entry-level homes, because there's no margin. There's less margin in those to begin with, and there's even less margin with the cost of materials up. So we can talk about, hey, yay, supply is better. When you go from 8-day of supply of homes to a 18-day of supply of homes, it's 2.5 times what you had, but it still sucks. It's nowhere near normal, and it's nothing that supports a supply-demand balance where home values are going to be moderating. I mean, they will moderate, but that just means because we're going from this absurd level that we had. The other thing on top of it, where we don't want, we're talking in the context of should we be investing in real estate. The economy is good, is going to be good for a period of time. Interest rates are low, going to stay low, despite what some crazy people think. And because of that, it's going to support home values. Is that 3 years? Is it 5 years? Is it 10 years? I don't know. It's really hard to say out that far. But the reality is, am I likely to sell that property next year, next summer? Probably not. I'm going to look at it and probably go, you know what? I'm pretty confident that next year will be another 4 to 5%. The property is going to cash flow, so why not hold it? So the key things there, I certainly wouldn't want to speculate in a really highly appreciated market like this. We had people get into problems in 2005, 2006, 2007 because they, at that time, had crazy loans. You could put very little down, non-owner occupied. You could do them interest only to make things cash flow that did not cash flow. So just remember, you want to make sure that you have enough to put down to make a property cash flow, that you have a cushion in case we have a resurgence of COVID or something else, and we have longer moratoriums on someone being able to post up in the property and not pay rents. So be reasonable and conservative about it, but I think home values are going to continue to go up. We have some serious tailwinds that are not going away in the near future.
Yeah, and I agree with Josh. I mean, we've talked about this multiple times. I think, if you're coming from the idea of buying an investment property, you've got to think one of two ways, right? You got to think either cash flow or appreciation. Here in Southern California, in Newport, it's going to be hard to get cash flow on a property without a substantial down payment. It's not reasonable just because of where values are. What I would tell you is that you probably have a better opportunity to go out of state and get cash flow properties. You could buy a couple for what, the down payment would require here in Southern California. Now, you're not going to get the appreciation per se, unless you have another year like we've had this past year. But, the cash flow is going to be there. And at some point, if you keep those properties long enough, they're going to be paid off. And it's a win-win situation. I think investing at the moment, I mean, Josh is in a great position to buy the property he has. One, because he's able to not necessarily get it undervalued, but it needs a lot of work. And so he's able to get it at a price where he can go in, and he's flipped enough properties that they can go in and do the work less expensive than most people can. And so in a quick manner. And so, he's going to be in a position where, it's still going to make sense based on what rents could get in that market for that property to cash flow. That's not often. And in Newport, probably not as easily to make happen. So just keep that in mind. Again, there's other places out of state I think you could put your money. But again, that comes with its own set of potential issues. And if it's a conversation you want to have, just feel free to reach out. And I think Matt, the mortgage guy, Josh had later asked where you bought that property. Was it Anaheim or Orange? I can't remember.
City of Orange.
So here in Orange County. All right. So hopefully that helps you. Yeah.
Well, Jeb, just let me circle back. I don't want to make the conversation too California specific, but it's always helpful. Most everyone knows what Newport Beach is. It's not the most expensive zip code in California, but it's pretty damn close. I mean, there's a handful of more expensive ones in the Bay Area, Beverly Hills, that type of stuff. So who does buy and invest in Newport? Oftentimes what I see is it's longtime experienced investors who've built up a bunch of equity exchanging into properties there. And the reason why is they're kind of trophy properties that you don't worry about dipping as much when the market goes down. You don't worry about vacancies. You have a higher class of tenant. So like when I see these properties in Newport, a lot of the stuff that I see come up is like a 20-unit apartment building. And you're like, you've got to be kidding me. They want $14 million for 20 units. But then you look at it that if you bought an apartment building or two in Anaheim, paid them off over the last 20 years, and they're worth $8 million, and you go, I can put $8 million down on that, and it cash flows really nice. And I don't have some of the same headaches that I have in another area. So for me as an investor, I don't have a giant nest egg where I'm looking to just park it and get safe, secure yield. I'm trying to get out there and get after money. So for us, again, everyone knows where Anaheim is, right next to Disneyland. It's a blue collar neighborhood, like everything in Southern California, rapidly appreciating. A lot of good people live there, and those markets, those neighborhoods are nicer than they were 7, 8, 10 years ago when we were having that downturn. So know why you're investing, who you are as an investor, and where you are in that cycle, because it's going to dictate the type of properties you're going to buy. I know a guy that when I was buying a lot of homes in the Anaheim, Central Orange County area, he was buying in Compton and like getting monster discounts, and he was making twice the profit per deal that I was. And then he had a situation where they finished a rehab, and before they could get the for sale sign in the yard, a gang had moved in and put like plasma TVs. I'm not saying they moved in and destroyed his property. They moved in and told him, no, this is our house. And he had to have the police go out and go, no, it's not your house. You have to move out. And I'm like, you know what? I'm a big guy. I'm a tough guy. I'm not sure I want to fight with gang members as to whose house it is when I'm done. And for him, it was great because he made a ton of money off those properties, but he had a lot of headaches that I didn't have. And I'm sure the guy buying in Newport would say, hey, you have a lot of headaches in Anaheim that I didn't have to deal with.
No, understood. So yeah, good information. Just it's not as easy as just saying, hey, do I want to invest? And now is a good time. You got to think about the markets and all that good stuff that goes into it. On an awesome note here, Joey Crack, look at that coming through. Giving Josh $50, but this is my channel, so I'm actually not going to give it to Josh.
You have to dole out the 805 allowance, bro.
No, you can't drink right now. You had surgery. I heard the doc.
Hey, I've got 21 days, 3 weeks till my birthday. So you're breaking out Joey Crack's money on my birthday.
Just kidding. But thanks, Joey, for support. We'll make sure that it gets in the hands of the person that helped you with the information that you needed there. All right. So gonna go back up here. A couple questions. Let's see here. Let's see here. Cano. I talked to my bank about starting the pre-approval work, and they said that the process could be done over the phone. Is this common practice during COVID, or should I wait to meet with someone in person? Josh, how many mortgage applications, loans have you closed where you've actually met face-to-face with the people in the last, let's say pre-COVID? Let's not even talk about the year of COVID, because that's a an anomaly, if you will. Prior to that, on an average year, you do 100 loans. How many of those people do you meet with?
Maybe one out of 100. And the funny thing is, I was thinking the same thing. I was like in the last 12 months, in the last 18 months, like 3 people have come into the office. And I was like, oh, that's COVID. And so I think the year before that, maybe 5 people came in the office. I'd say 1 to 2 out of 100 would come in and meet with us. Partially, like we're in Southern California. I had a friend who has a mortgage brokerage out in Colorado, and he was in here just watching what we do and checking out some of our systems a few weeks ago. And he's like, I probably meet with 30 or 40% of my clients. But he's in a smaller town outside of Fort Collins. There's still a lot of we know you, and it's a small town where there's not a lot of traffic. So wherever you are, it's a 5-10 minute drive over to his office and sit down belly to belly and go through it. So awesome if you can do that. What I will say is some of the best transactions we have are the ones for the clients that can come in and we can sit down and they get super comfortable and answer all of those questions. I would say second to that, going through everything on a Zoom or a Google Meet is super helpful, just because we can both look at the same documents and the same numbers, and it just opens up those same questions as if you have them here in the office. And if you come into the office, I have a giant monitor in my office, and it's like, hey, swing around here, or I'll swing the monitor around. Let's look at the same stuff. It's even easier on an online meeting where you can go through that. So in terms of the mechanics of it, what I'll tell you is that even if you want to come meet with me in the office, that's awesome. But we're still going to do the same things as if you never intended to come into the office, because it doesn't make sense for you to come in here without completing the application and out without supplying your supporting documentation, because all of that is it's the paperwork that you have to do when you go to the doctor's office before you see the doctor. So you don't have to do it before you go to see the doctor, but you're going to sit in the lobby and just fill out a bunch of paperwork before you get there. So that's not a good use of your time or mine. So we're going to send out the portal invitation to our secure online portal. There are still a minority of people that freak out about, I'm not sending my stuff online. Well, we have a secure portal for a reason with all the fancy encryption technology, and we're going to have a discovery call. So you do this all the time. People will contact you, and you say, hey, Josh is my trusted lender. I'm going to connect the two of you. And the first thing we want to do is a discovery call. I know lenders, and I know actually good lenders around the country, and the first thing they do is they get that email and they go, hey, here's my online application, fill it out. And it's like, you're asking someone for their social, their date of birth, all these things, and you haven't even had a conversation. First thing I want to do is for myself or one of our team members, Russ or Jesse, to jump on the phone and go through just a discovery call. What are you looking to accomplish? Okay, you're in Anaheim and you want to buy a condo. Okay, the size condo you need is 3-bedroom. Even in Anaheim, they're 550, 650. Does that sound about right? Yeah, I'd say 600 is about right. Okay, and HOA dues you're seeing about 300. Okay, cool. Tell me about your employment. You work for someone else, you self-employed. Tell me about your down payment. How much is it? Where is it? So we're going through those things. So I have a pretty solid idea of what you're trying to do, but most importantly, I'm sending you that portal request for exactly the documentation that you need to get you a rock solid pre-approval. And now once we have that, it's going to raise questions for me. And now what I tell people, I had a conversation with some clients in Lake Tahoe. We had a conversation 2 days ago, and she says, should we be asking more questions? And I said, honestly, you're going to ask a ton of questions. It's just not on this call. You guys have 2 or 3 questions. I've got 5 or 6 questions. It's a 10, 15-minute phone call. Now you're going to provide all your documentation. It just came in today. So later tonight or in the morning, I'm going to review all that. I'm going to put together a couple of options for what they want to accomplish. I'm going to send it over to them, and they're in Tahoe. They're not coming to my office. So we're going to do a Zoom call and go through all that, and that will trigger their questions and answers. So long way of answering M. Cano's question here is, it's not the method of how you do it isn't important. It is important that you get on the phone and talk to someone that answers all of your questions and is asking good questions to answer, to understand your scenario. I am thinking like an underwriter when I'm going through that interview. I'm looking for you saying things that are a little red flags, not red flags that you don't qualify, but red flags that we need to dig a little deeper. We need to get a little more documentation. We need to make sure we're rock solid. We never, I mean, legitimately never have a file go into escrow and not close. And the reason for that is we do our work on the front end. You know, a lot of people do these quick pre-approvals. Hey, we do it over the phone, so I'm going to take an application, send me a pay stub and a W-2. They send them out with a realtor with a pre-approval letter, and it's worthless because they didn't do the homework on the front end. So long answer, but I would definitely say it doesn't matter how you do it. It just matters that you're having a good line of communication and you're securely providing the documentation necessary to get a full and accurate pre-approval.
Very long answer. Very long answer, but it was a good answer. So hopefully that helps you out. Yeah, just make sure you're working with a professional, right? And they're going to ask the right questions. and you'll be in good hands. So let's move on to Dar was here. How are property taxes paid after the eight months paid at closing? Every month, are they just included with mortgage payment? Will my payment go up at all at this point or at that point? So Josh can answer this one again, but I'll give him a second here. So typically, if you're paying your 8 months up front at closing, you're getting impounds, which means that your taxes and insurance are included in your mortgage payment. And what happens is when you make that first mortgage payment, you're essentially adding, when you pay those 8 months, you're paying, maybe a portion of what is, well, you're not paying a portion of what is due. You're actually building that reserve account, that impound account, so that when your taxes are due, there's enough money in there to pay the taxes. And so every month going forward, when you make your mortgage payment, you're adding to that account and so on and so forth. So that, every month your taxes are included. So in theory, your taxes shouldn't go up really, but every couple of years, you're going to get some sort of assessment that shows that, maybe your impound account is a little bit less or maybe a little bit more, and it'll be adjusted a little bit in order to compensate for any variation in those taxes. But Josh, what's the easy answer there? Because I know your answer is a little more streamlined, probably.
Bro, I give the long answers. I don't know.
I know. Streamlined answer. Looking for the quick one.
Streamlined answer. I'm going to assign myself a task here. I just got my escrow impound analysis. We refinanced in October, and all of my numbers, obviously I know my numbers, I know what my taxes are, I know what my insurance is, and they have not changed, either one of them, since that time. And we just got a notification that our payment's going up $200. That's $2,400 a year. I have no idea how they could have got themselves that far off in that period of time. But the question is, what you're paying up front is the amount needed, that with the number of payments that you're going to make before the taxes come due again, and for us in California, then due again, they'll be due twice before you get through that first year. Just making sure that there's enough in there with the amount collected, in this example, 8 months at closing, plus the monthly payments between when they come due again, that there's enough there. And always remember, there's a pad there. By law, they're allowed to keep a little bit more than what is required. And you would think that pad would mean that they're not asking you for more money every year. But I get this call from our clients all the time. And despite us having our numbers dead on, those impound accounts do fluctuate from year to year.
All right. Al Bundy's got a question here. What are the 6 contingencies in California? I feel like I'm being tested here. Al,
that's a trick.
So what is a contingency first off? So a contingency is essentially a backout clause, right? You get into contract on a property to purchase it. You have 6 contingencies, 6 reasons to potentially back out of a property in the state of California. Now, each state's going to vary a little bit, but you typically have an appraisal, you have the home inspection, you have the loan, you have seller disclosure. So here in the state of California, the seller has to provide certain disclosures that go along with, selling that property. You have the prelim, which is the title report. You get an opportunity to review the title report to make sure there's no liens, nothing crazy going on with title with regards to easements, any of that crazy stuff. And then lastly, you have HOA docs. So if the property's in an HOA, it's a condo, it's a townhome, maybe it's a single family that has a homeowners association, has CC&Rs, that would be the 6th contingency. Otherwise, you would just have 5. So, and then in this market, a lot of people are waiving that appraisal. Some people are waiving that loan. So when you waive those contingencies, obviously you have less opportunities to use those to back out. Now, in the state of California, it's not really said, but the reality is you can just change your mind, and nothing can really be done. I mean, I know some states where they say, you don't really have that option. You can't just say, I've changed my mind, I don't want to purchase it. But I've seen it here in California many, many times over the years where people just get cold feet and decide not to move forward. And that's the end of it. So, that's not an actual contingency, but, just keep that in there as well. But you can't say, I'm waiving the appraisal and the appraisal comes back, $100,000 less, and you're like, I just changed my mind. I mean, the seller's probably going to come after you at that point. But hopefully that answers your question, Al.
Before you get to the super chats, do we want to do the Al Bundy section of the show? Because he's got 2 more questions that are good, and this one I can actually be quick with. Can you purchase a home in a trust? You absolutely can purchase a home in a trust. You have to provide it to the lender upfront to be reviewed and just make sure everything meets their requirements. But we do tons of loans in trusts, either purchases or more commonly, someone's already owned the home and moved it into a trust. Now, Jeb, Al's last question or third
No,
question
he's
is,
got another one. He's got another one in there about reverse
Al,
mortgages.
Al,
Let's come back to Al here.
all right.
Just get the super chats and we'll come back here. Honey Buns is scared every show.
Paying to tell you that they're scared
Hey,
every show.
but by the end of the show, Honey Buns isn't going to be scared, and maybe that comes with another super chat. I don't know, but thank you either way. I screw this up every time. You'll lose. As a first-time home buyer, first off, thank you for the super chat. Much appreciated. As a first-time home buyer, super thankful to both of you for educating us here. Assuming the rates don't change significantly this week, I am locking in 3% at no extra cost, 30-year fixed, 35% down jumbo loan. Yay. So not really a question there, but 3% on a jumbo loan sounds like a solid deal with especially in the market where rates have actually gone up a little bit recently. So yeah, congratulations to you and appreciate the support. Thanks for being here. I know you're here often and showing up. So thank you for that. GD got my offer accepted today and may need to prepossess the house prior to closing. Is that something you see often? Prepossess. Can we, what's prepossess mean, Josh?
Move in prior to closing.
Prepossess. Is that an actual word?
That's the only thing I can guess.
Did GD just make up a word? Is that you just add pre in front of anything?
It's possible.
It's a word now? I'm just giving you a hard time. Can you move into the house prior to closing? Is that something you see often? Yes. I mean, I wouldn't say often, but it does happen. You just got to make sure that the seller's okay with it. I mean, obviously there are risks involved, right? The seller has insurance on the property before until they close on their property, until it records. So you moving in early of that, to that property, something happens, the seller is essentially the one that has to, their insurance is the one taking care of that. So there's obviously some liability there, but there are forms that you can fill out to waive certain liabilities and what have you. But to answer the question, it does happen. You just got to make sure the seller's okay with it. You need your agent to talk to the other agent to explain the situation as to why you might need that. And oftentimes it might come with paying a little bit of rent as well, so paying the per diem for whatever the seller's mortgage is during that time. So if the property's vacant, you're probably in a better position to get that done. But yeah, it does happen. But you need a professional trying to negotiate, right, and to make sure they can do it. And don't be surprised if the other side's difficult on that end, because obviously it does come with liability. All right, so we're going to move back up, but thank you for the super chat too, GD. Much appreciated. And if I didn't answer your question fully, just go back in there. So we're going back up to the Al Bundy show. Was that it?
Yeah. So we're not answering reverse mortgage questions tonight, though.
All right. So how do buyers ask the seller for closing costs? I've heard offering higher than the agreed upon price and asking for that back in closing cost credit after offer is accepted. Yeah, I mean, that's more or less how it happens, right? So it's built into the initial contract in most instances. So say a property is $500,000 and you want, $10,000 worth of closing cost credit. Typically what your client is going to do, your agent is going to do is you guys decide on what your offer is. So let's just say that the house is worth $500,000 and you're offering, $500,000, or that's what would be a reasonable offer. You might offer $510,000 and ask for $10,000 back towards closing costs in that initial contract. Now, in the environment that we're in right now, harder to do, right? When it's a seller's market, you've got multiple offers. A seller's looking at offers. It gets more convoluted, even though it's not really a convoluted thing to do in an offer. When you're asking for a credit, even though you're building it into your offer, a seller might look at that and go, well, this guy's not doing that. And maybe that the other person is offering the same price and not asking for a credit. So you have to weigh all of those things when you're considering asking for a credit. It usually happens more in a buyer's market when you can start to build those things in. I do know they're still happening out there. But I think you're here in Orange County, if I remember correctly, And it's harder to do in our market. But talk to your agent about it and get their guidance on how to go about it. And keep in mind, you can also get a credit for closing costs from your lender, right? I mean, in some cases, you might be able to take a little bit higher rates. So say rates are 3%, you might be able to take 3 1/8 or maybe 3 1/4 and ask your lender, hey, by taking a little bit higher rate, is it possible to get some of this money towards closing cost as well to take that credit and make that happen. So that's also an option outside of and probably the better option, quite frankly, in this market, because it doesn't involve the seller at all. It involves you and your lender. And if you're in the camp that rates could go lower at some point in the future, whether it's 3 months, 6 months, 2 years from now, you might be in a position to refinance and take advantage of a lower rate and still have your closing costs covered initially through that. Josh, thoughts on that? Right, we actually have one right now. VA buyer, they're using essentially their money for an appraisal gap, $10,000 towards appraisal gap, and they took a little bit higher rate to get a credit to cover the closing costs.
Yeah, and that was exactly the funny thing is a little bit of a difficult file. So it was one that we actually sent out to the lender ahead of time to get their rubber stamp on. Did that two months ago. It's taken him a while to find a home, and of course, the lender who already approved his loan now has terrible pricing, and we needed that lender credit. So it's a better option. I was going to ask you, Jeb, when was the last time you saw a seller credit?
Wow. Me personally, I it's been a long time. Years. I mean, so long I can't tell you when it was. But I have, agents that are around me constantly and networking and whatever. And I've heard of agents being able to get closing cost credit included. So I do know it happens. I just don't know that it happens very often. And I don't know how often it happens in our market. So
I would have to go back and look at all of our purchase agreements for this year, but I don't think I've seen one at all this year. So that would also include like November, December. We'd have to go back to some point last year to even see it. So it's been more important for us, like a lot of times. So I have a client who's looking out in the Menifee area to buy a home, and they're at their max qualification. So we needed a lender credit, and it's like we had to back them down about $10,000 or $20,000 so that they still fit within the debt to income ratios and getting them the lender credit, because that's a crazy first time buyer market out there. There's no one's giving a seller credit. The crazy thing is, I will say, we got an appraisal in this week, and 2 of the comps were adjusted downwards because of a $1,500 and a $6,500 seller credit, and I'm like, how are 2 comps in one neighborhood getting a seller credit when I haven't seen one in 6 or 8 months? No. So yeah, the lender credit's the better option right now.
No, absolutely. And Dar was here. He said he was talking about insurance. The same thing works for insurance, right? So it's the same as taxes. You're just prepaying that bill every month with your mortgage payment. So at the end of the year, when that bill comes, it gets paid through the escrow account. And again, there could be fluctuations there as well. Insurance premiums go up over time, something to pay attention to, something to definitely pay attention to. If, you can have the same exact insurance and all of a sudden, or not the same exact, they start charging you more for things that you don't necessarily need. And that bill goes up. So just pay attention to that if you're, when you get that bill. But there was a good question here earlier that I wanted to address, Josh. Maybe you could shed a little bit of light on it too. So comes from Sharon. Where's all the cash coming from? If it's not from foreigners, is it from drugs, cash, stocks, or what? Sorry if it's been asked. I arrived late. So, this, one of the recent videos I did talked about, 25% of the purchases, I forget what the month was, were actually cash buyers. So 25%, 1 out of 4 were cash buyers. And the question is, where is the cash coming from? It's hard to say exactly where it's coming from, but understand a lot of people made a lot of money over the last 12 to 18 months, whether it's coming from property, whether they sold property, they have a ton of equity, which is honestly probably a good portion of it. Maybe not here in Southern California, but people made equity in their properties here in Southern California and were able to take that cash and buy out of state. And that accounts for a large portion of those cash purchases, is people taking that money from equity they've gained here in California and moving it other places. And you also have people that have made money in equities, right? And they're worried about a top in the stock market, looking for something more stable. And maybe they've cashed out equities for whatever reason, stocks, what have you, and using that cash to buy property as well. So it's hard to say. And then you also have the people that do the 1031s, right? So a 1031 tax exchange, an investor sells a property. A lot of times they have equity in it. They use that money to purchase something else, and maybe that there's enough cash in there to buy what they need without having to take on a loan. So it can come from a number of ways. I mean, people are shocked that because of where prices are, that people have the cash to do it. But again, as many people were hurt in 2020 by what happened, there were just as many people that did really, really well during that time, and made a lot of money, and that could be one of the places it comes from. Josh, anything you want to add to that?
The MBA, the Mortgage Bankers Association, came out with their numbers today. April of 2020, 17% of purchases were all cash. Last month, they were 25% of all transactions. That's where you saw it. And also would say that it is largely a function of real estate is a hard asset. So a lot of people that are worried about, other things that they hold, is the stock market a bubble? They know that a house, it can depreciate, it can go down in value over time, but it's an asset that is there, and it generates a yield. We talked this about the big institutional investors that were buying and acquiring rental properties in the downturn, and the expectation was, hey, once the market recovers, they'll liquidate them to get their cash back. And what we're finding is there's nowhere to put that cash that gets as good of a yield. If you have a $300,000 house that generates 25% or $25,000 of rent every year, it's a pretty good yield relative to just parking it in the bank or putting it in treasuries that are at like 0.5 or 1.5, depending on the duration of that treasury. So especially as people get older, accumulate a lot of assets, hard assets like real estate that will generate a yield, which is better than putting money in the bank, becomes really attractive to them. So I often ask the same question: is it drug money? Is it lottery winners? But there's too much of it out there. And I would say that a chunk of that 25% of all cash buyers is big institutional investors. It's not just your neighbor down the street going and paying cash for a home. We talked about, I forget who it was, KB or someone sold an entire neighborhood of 100 and something houses to an institutional investor. They would fall into those numbers as well.
No, it's impossible to say where it comes from. But again, there's a lot of money floating out there. There's still a lot of money on the sidelines, in my opinion. People wanting to buy, institutions wanting to buy. And that's why I think if there is any dip in the market at all, you're going to see demand there. I mean, any property that comes on the market for less than what properties have been selling for are going to get picked up quickly, right? I mean, it's just the nature, because somebody sees something now that's less than what they were willing to pay a couple of months ago. Maybe an opportunity for them to jump in the market. Let's see here. We got another chat, I think. Did I see one? Jennifer Jennifer gave us. So Jennifer is a loyal and dedicated, subscriber, also a moderator here in the chat. Not necessary to give money to say hit the like button, but hit the like button. Listen to Jennifer. She's the boss here, and
she's contributing to my birthday 805 fund because I think
she's contributing to a Christmas present. She's just gonna we're just gonna give her it all back in some sort of Christmas present. We should buy her I don't even know if she drinks. We just give her cases of 805 just for ship them across the country. All right, we had some good questions up here, Josh. That there was one on. Here we go. Flash a light. How bad is it to have a judgment lien or mechanics lien prior to selling or refinancing? It can't be paid via escrow in a sell or cash out refi ? So maybe start by explaining what a judgment lien or potential mechanics lien is, and then maybe how they might affect the purchase or refi.
Let's use an actual example. My little house I'm buying in Orange. We know that it's in bad shape. There's a mechanics lien. The seller decided about a year ago he was going to try and put it back together himself. Hired a guy to come replace some of the busted out windows. They got into a disagreement about the quality of work, the windows that he was putting in. Never paid him $6,000 and change. So the contractor's last resort on that is to go to court and file a mechanics lien. You can fight that if he truly truly had not done the job right or provided the wrong windows, my seller could have gone to court and fought it. He didn't. So there's a lien against the property. Doesn't show on his credit report, but it does show on the title report. When they do the research, it says, hey, this is a lien against the property. And any judgment, let's say, you know, he had run down his neighbor's Harley when he pulled into the driveway drunk one night, could be a judgment against him. You need to replace this guy's Harley, and you put the lien against his asset. So all it is you owe someone money and they've attached that amount to your home. So absolutely, in this situation, it's very easy. My seller's not qualifying for a loan. I'm qualifying for a loan. So we did have to go back to the window contractor, who was not really happy with this situation, and get a payoff demand from him of, this is what you were owed. Here's interest, penalties, court filings, all of that stuff. And we are paying him through closing. Now, let's say if the guy wasn't selling me the property, he was wanting to refinance it, it probably would be fine to pay it off with the loan. But what it would do is you couldn't do a rate and term loan where you're just getting a new loan to replace the current loan, which gets you the best terms. That money to pay that off would be considered cash out.
Right.
It's not impacting his credit score right now, so it probably wouldn't affect the loan in many other ways. As long as we met the LTV guidelines, we can pay off the lien against the property with the refinance. Now, if you already had really dicey credit, if we were already really high loan to value, it could torpedo a deal. But in most situations with a seller or a buyer with a refinancer with equity, it can be taken care of that way.
All right. Good answer. Good stuff. Let's see here. Angel Torres, what do you think about the Bay Area? It's crazy. I don't really know the numbers in the Bay Area. I do hear a lot of people talking about supply being higher in the Bay Area. And I recently did a video where I discussed inventory in the Bay Area. And it was one of the few markets where inventory hadn't actually declined year to year. It had actually increased year over year, but at the same time, you were still seeing crazy appreciation. So, I mean, it's one of those markets that it's always going to be desirable. It's always gonna, you've got the tech, up in Silicon Valley and all of those areas around it. It's always going to be, there's going to be people that want to live there. As many people that say it sucks and all of that good stuff. There's just as many people that want to be there. I don't know if you can continue to see the appreciation that you've seen up there for over the next couple of years, but it's a desirable market, right? And until demand starts to slow down and you really start to see inventory build, I don't know that you're going to see much change in that market. I do know that a lot of real estate agents up there price properties low to generate these crazy offers versus pricing them closer to where they think they will sell. So there's also that added into it. In fact, I recently was in a big mastermind group with a lot of agents, and a couple of in my group were actually from the Bay Area, and we talked about this, and they expect the market to kind of more or less continue down the same path. So I think, without being up there and really knowing the ins and outs of it, I think you're going to see a similar market in the Bay Area as to what you've seen over the last year or so. Now, maybe not with the appreciation, but demand's going to be there. All right. XX. Hi, when would you think is the best time to sell a house in San Diego by the next few years? Tough question. A bird in the hand is worth two in the bush, right? You could sell now, exactly what kind of market you're in. Waiting, you're guessing as to what will happen with the market. Now, again, how many videos I've done. But last video I think I posted, they're expecting another 10% in San Diego from right now till this time next year, another 10%. So depending on where you are, value wise, by waiting and selling later, chances are your property value is going to go up. The question is, where is competition at that time? Where is buyer demand at that time? I think Josh and I are in the same camp that we think property value is going to be higher than then next year, this time, but we don't know what demand and all of that stuff is going to be, when you decide to sell the property. So it's a tough question. But San Diego is always going to be a desirable market, and you're probably in good shape, and you probably got another couple years of this in my opinion.
I always fall back to the same question: sell and do what? Are you selling and moving
Right.
out of
No, that's
state?
good. Yeah.
Are you selling and moving up? Because if you're selling and moving up, do it now, because the gap's going to get bigger if they both go up on a similar percentage basis. If you're selling and moving out of state, all the things you said just about supply of buyers being high relative to the homes available. So I'll always think in terms of, it's not just as simple as, hey, I have a home in San Diego, when's the best time to sell? It depends largely on what you're doing. And one of the interesting things, you go back in time, we've always had a fairly substantial discount of San Diego to Orange County. And to me, it didn't necessarily make sense, other than maybe more jobs in Orange and further up into LA County, because their climate's better than ours. Ours is awesome. Theirs is even better.
Yeah.
So I've never really understood why the values were lower. And I think kind of what we're seeing is just a correction of the market going, hey, it's the same awesome Southern California weather. You're close to the beach, lots of jobs, and they've done really, really well. I mean, for what, a year and a half now, you see every month they're in the top 3 to 5 markets nationwide for appreciation.
No, it's crazy too, because when I think of San Diego, my mind immediately goes to La Jolla down to the gas lamp. I don't think about anything east of basically what's along the coast. And San Diego is huge. And so, a lot of where you see these properties selling aren't the coast. I mean, they're coastal properties too, but there's a lot selling inland. And for a long time, those property values, like you said, were less than some other areas, but now they're starting to see that appreciation. But I'm often reminded that San Diego is not just this small little sliver of what I think about when I think of San Diego.
Yeah.
All right. Let's see here. Arold.
Maybe the N on the end was he just took it out of the middle and tacked it on the end.
I think so. I think he's playing games with us, but we're going to call him A-Rolled. A-Rolled in.
I'll trick these guys.
Yeah, I have 11 months remaining on my student loans. How will that count toward my DTI, and how long do I wait for it not to count toward my DTI? So 11 months remaining on student loans. Are you still factoring that into monthly DTI?
Yeah, installment debt 10 months or less can be ignored, but there is underwriter's discretion in there. So I would assume that's a fairly small amount at this point. What happens is, when would an underwriter not allow you to exclude an installment debt with 10 or less months remaining? It's, let's say you have a Rolls Royce and it's got a $3,500 monthly payment, and that puts your debt to income ratio, including it, at 65%. They're going to say, I have no idea how you're going to make your mortgage payment for the next 10 months, so we have to count that against you. Now, if you have a student loan or a Toyota Corolla with a $220 payment, and it takes you from meeting the guidelines to being slightly over the guidelines, they're going to exclude it 9 times out of 10. So it sounds like any student loans with 11 months or less remaining, it's not a huge amount unless you're just truly attacking them with big payments every month. So I don't think it's going to make a big difference in your qualifications one way or the other, but you would need to get them under 10 months to ask to have them excluded.
Got it. All right. Good stuff. Let's see here. Surf City HB. So that's Huntington Beach for you guys that don't know. We're Surf City here, Huntington Beach. My agent is telling me to waive the inspection on an offer we are going to be making. He said that will help stay competitive. Don't feel great about that. Thoughts? It's crazy. I never recommend waiving the inspection. Now you can say that you're willing to buy a property as is, which in theory kind of means the same thing, but you're still able to do the actual inspection. You're not waiving your right to that inspection. So I say no. I say don't do that. But I'm not your agent, right? So I can't really give you advice on what you should do. If you trust your agent, then go with it. If you don't, you need to find a new agent. But with that said, waiving your right is one thing. I mean, you need to have an inspection, right? And it doesn't matter if you're buying a condo, a single family. I've had a couple people reach out recently, say, "Hey, look, I'm buying a condo, and my agent said that I don't need a home inspection because it's a condo." I'm like, what? No, you still need a home inspection. I mean, there's still things in a condo. And their argument was that the HOA will take care of it. No, the HOA does not take care of it. The HOA is responsible for the exterior of a condo in most cases, not all cases, but most cases. But there's still items in that property, the furnace, if there's an HVAC or an air conditioning, if you have a dishwasher. I mean, there are items in there that are water heaters. I mean, there are costly items that you need to know whether they work or not. And, it's one of those things. Now, if you were a flipper, if you were buying a property and you were buying it cash and you were going to gut the thing and all of that, then okay, I get waiving an inspection because it's pretty much irrelevant. But if you're a buyer that's going to live in the property, I think you need it in place. And so I personally don't think that's great advice, but I can't really tell you one way or the other, but I think I did. So Josh, thoughts?
What I would say is almost every client we have that's waived their inspection is still doing the inspection. So it becomes a shell game. Like every seller says, I want a rock solid deal on day one, but they don't put themselves in the buyer's shoes and go, if I find something that's horrifically wrong with this property, I'm not going to go through with it. And unless they literally waive everything right at opening, inspection, appraisal, HOA docs, no one's waiving seller disclosure, so they can even use that to wiggle out. So you do your inspection, there turns out that every appliance in the place is on the fritz. Even though you bought it as is, you can still go back and ask them to repair it. Even though you didn't have the inspection contingency, all that means is I can't back out because all of the appliances are wrong. I can still go, you know what? I don't like your seller contingencies. You told me that, your dog pooped in the corner and I don't like that. So I'm out. So it's a little silly. It's a little bit silly.
It is. And as an agent, as a professional agent on the side representing the seller, I'm when I see a buyer make an offer, I'm never going back to the buyer and saying, you need to waive your, inspection contingency, right? I mean, I'm having a conversation with the seller going, listen, they're waiving their appraisal or whatever. Let's compare the offers. And maybe if you have somebody that just came in and did it, okay, that's one thing. But you're like, never in a counter offer are you going to see me go back and say, you need to waive your inspection. I think it's ridiculous. And you got, I tell sellers all the time, you got to think of it. You got to put yourself in the buyer's shoes, right? And when buying a property, and I say the same thing to buyers, you got to put yourself in the seller's shoes. You got to think how the other side, that's typical negotiation. If you're not thinking how the other person's going to respond, react, then you're doing yourself a disservice when you're trying to negotiate some of this stuff. But what I will say is in the last two deals I did, both we said we were purchasing as is. We didn't say we were waiving contingent or home inspection contingency, but we did say as is. And both of those, I got repairs done. Both. We went back to the seller and just said, hey, look, there were a couple items that showed up. I know we said we would buy the property as is, but my client, these are things that we feel like, should be taken care of. And both of them did it. So that's the route I would go versus the other route, but that's just me. Let's see here. Josh, one for you. Are VA loans lower rates?
Lower than what? Lower than conventional, lower than jumbo? Yes. FHA is just a slight hair bit lower, and I have never got a really good answer on why that is, but for all intents and purposes, FHA and VA are the same, and they're lower than conventional loans. Conventional is generally lower than jumbo, but jumbo is getting really competitive. Jumbo got the most difficult during COVID as all the investors backed out of the market, and they're all flying back in wanting jumbo loans right now. But VA is always going to have extremely aggressive interest rates, and they don't have mortgage insurance. So depending on if you've ever used it before and what your funding fee looks like, or if you have a service-related disability that makes you funding fee exempt, for most people that are VA eligible, it's just an amazing loan and better option for them than just about anything else.
All right, I like it. Let's see here. So we got a question from Ray. It's two parts here, or not two parts, one part, but he gave us some additional information. If you own a property and rent it out, when can you purchase a second home? His first loan is a conventional with no PMI.
So anytime you want, if you're renting the property out now, so I guess the follow-up would be, if you own a property and then decide to rent it out, when can you purchase? Immediately. So the only limitation that you have is if you purchase a home with owner-occupied financing, you are telling the lender that you intend to occupy the home as your primary residence within 60 days. Everything beyond that is totally open to interpretation. for the first year, if it's a Fannie Mae loan and you go to apply again for another owner-occupied loan, the Fannie Mae automated underwriting findings will pop up a warning. Hey, this person did a Fannie Mae owner-occupied loan within the last 12 months. It does not disqualify you. We had a very bizarre situation in March where the people closed on an owner-occupied refinance in January, like the last week of January, immediately went out and found and fell in love with their dream home, and we were able to do another owner-occupied loan for them 2 months later. It was very unique, and the lender was very kind in how they accepted and understood what happened, because it was truly honest, and I had emails backing that up. But I think where Ray's going is just how quickly can you do that? You know, if you've been in that property for 6 months after doing the owner-occupied financing, I've never had a problem doing another owner-occupied loan. After 12 months, I would say no lender would have a problem, because life changes. You get a job change, you get a new girlfriend, new boyfriend, get divorced, any millions of things can happen. So you are fine to rent it out and purchase another home at any point. And you say purchase a second home. If it's a second home, truly a second home that you're going to not live in as your primary residence, you can do that anytime you want. If it's another rental property, you can do that anytime you want.
All right. Good stuff. Diogo Pereira. Will buying a multifamily home with an LLC protect me from a lawsuit?
It would protect you as an individual. It's not going to protect the house or the home equity. So if the LLC owns the property and someone slips and falls on the property and there's $250,000 of equity in the property, they can still sue the LLC or you as an owner of it. What it does is it protects you from personal liability. They have to go after the entity. The bigger issue you're going to have with that is Fannie Mae and Freddie Mac and FHA and VA will not lend to an LLC. So there are lenders that will, but they're going to require a bigger down payment. They're going to have worse terms. So for the most part, anyone that wants to do this, they buy as an individual and then transfer it into the LLC after. Without going too deep in the weeds for you guys, there is a due on sale clause in your mortgage loan documents, and technically the transfer from you to the LLC is a sale. I've never seen a lender trigger the due on sale clause because of that, but they could if they really wanted to get picky with you.
All right. Let's see here. Nightbot says, if you find the content helpful, make sure you click the like button and subscribe to the channel.
Are you paying Nightbot for doing this?
No, I just click on Nightbot. You know, I have Nightbot set up. Nightbot is like a moderator of the chat. So I thought I liked it. I wrote it and I liked it. So I put it in there.
Can you rename Nightbot, or is Nightbot like, no, I'm Nightbot? You can make me say things, but you can't rename me.
Exactly. Yeah. I mean, otherwise we would name him like Joey Crack 2 or something. or like the better Joey Crack.
So did you watch the Friends reunion? They talked about on there.
Not.
So they brought up my wife and I, because I'm still recovering. I could go nowhere. We've watched everything on TV. I'm like, all right, we'll put it on there. But anyways, they brought up the episode where Joey actually had a double. So you saying that, I was like, we could make Nightbot Joey Crack's double, and it would be a weird doppelganger like Joey had on Friends for a couple of episodes.
You know, too funny. On a side note, mentioning shows. So I watched the Pink documentary last night on Amazon Prime. If you haven't watched it, I'm not just talking to you. I'm talking to anybody on this. Good stuff. Like just performing at a high level. Like just good. Great documentary. Anyway, that was my 2 cents. Have you seen it?
No, I think I saw it pop up because, again, we've seen everything. So since I have seen everything and I'm digging for stuff, I'll do it.
I've never been a big Pink fan, but good, music, not really my genre of music per se, but just a good documentary. So worth
for
watching.
Those of you wondering what his genre is, it's Pandora. He just types in EDM and lets it go.
No, that's not true. I actually don't have a genre.
He just types in EDM and lets it go.
You're still mad that I still use Pandora and not Spotify, but that's a whole different thing.
Yes, that says you're 78 years old.
All right, we're gonna get some questions answered. So Lupita, that's Lupe. Hi, Jose Luis. Glad to see you both. It's been a while. So Jose Luis is Josh there. All right.
While I was, they closed like 2 days after my surgery, so I didn't even get to congratulate them for like 10 or 14 days afterwards. So
Yeah, that was
happy,
just you're just slacking. You're just slacking. You're
super
just using
super
that.
slacking,
You're just
super
using that.
slacking.
So Joey gave a $50 super chat earlier, so I feel like we were obligated to answer his question here, especially after we've been ragging on him. Does the lawyer or the agent look into the actual tax history and assessment on a property, or is that caveat emptor type of thing? So when buying a property, what'll happen is the lender is pretty much the one. When Josh looks at the numbers here and he's calculating what your mortgage payment's going to be, he's pretty much pulling the tax rolls or what have you and figuring out what the tax basis is, and that's where the numbers come from. Now, outside of that, is escrow doing anything with regards to the county to verify tax information there, Josh, with regards to what's included? I don't remember.
Yeah, so we're having to provide tax certs from the county of
That's right, it's a
showing what
tax cert.
the actual taxes are. But when he's saying tax history in the assessment, they don't really care what it was 3 years ago or 10 years
Right.
ago or 25 years ago. They want to know what it is right now so that we're using the actual current assessment. And remember, Jeb and I are in California. We have weird rules here. So a seller could have really, really low taxes due to Prop 13. So taxes can only go up 2% a year. Some people bought their homes 30 years ago. They're paying a tenth of what the property taxes should be. Most other states don't have that. You're getting reassessed every year. And I look at assessments in other states and I'm like, this is so weird. Like, why is this number? I'm going to put names to this, but I have a family member who in Washington owned an apartment building, 40 units, with his ex-wife, and they were obviously didn't like each other and didn't get along very well. And after about 10 years of owning this jointly, decided this isn't working. And so she, in a fit one night, said, "This doesn't work. Either you're buying me out or I'm buying you out." And he says, "All right, the tax assessment says it's worth 1.8 million. I'll give you 900,000." She goes, "Done. Cool." The property was worth $4.5 million at the time. So he won that battle with the ex-wife
Yeah,
because she accepted
Yeah, he did.
the assessed value. So again, that's me being ignorant of other states and how they work. I know that state's not dumb. They knew that property wasn't, that Washington state knew that it was worth more than $1.8 million, but for whatever reason, they hadn't reassessed it to the current market value, and that worked to his advantage.
Yes, it did. All right. Let's see here. So Lakeisha, I bought a home what's that?
I'm just going to say I am stunned and amazed because we have a client that Rick is working with right now that is Lakeisha Childers. So to see Lakeisha Walters, and she may be Lakeisha, the other one, it's the I is before the E, but it's not a common name. You don't see it a lot. So I was happy to see another one.
Oh, there you go. You're shocked. I thought maybe you were working with
I'm like,
for a moment.
I've never seen another Lakeisha.
All right. So I bought a 3-family in September. So a 3-unit in September, owner occupied. When can I apply for another loan for an investment? So typically what happens is you buy a 3-unit property. You can live in one of the units, rent the other 2 out. That's still considered a primary residence. So that was in September. So she's asking, when can she do it again, Josh?
Well, she ain't saying when can she do it for an investment. For an investment, you could have done it the day you moved in. There's no wait for being able to buy another one as an investment. Now, if you said, "Hey, I'm going to convert this to an investment and I'm going to go owner occupy another 3-unit building," you may have a tough time at any point with an underwriter accepting that. So let's say that there are 2 identical 3-unit buildings right next to each other, and the next one comes available, and you're like, "I want to buy that one too. I'm going to go live in that." You could have an underwriter saying, "I don't know why. It's the same property. It seems to me like you're just acquiring another investment." Now, if it's been 5 or 7 years, you've built up some equity, you might be able to get away with it, but it depends on what you're doing. If you're trying to say that you're going to own or occupy it, there has to be a valid reason as to why that property is superior to the one that you're in. If you're going to put a bigger down payment and do it as a pure investment, you can do it the day after you purchase this home.
There you go. All right. Listen here. We got a good question here, Josh. And actually, I have a more important question than the one that he's asking. Andrew Z. We are in Wisconsin and the Midwest is booming. Why the Midwest? What is the attraction?
It's way cheaper than the coasts or the Sun Belt.
So that's the answer to his question. But my question, I think, is a more relevant question. And that is, why the hell is it considered the Midwest? Like, looking at a map, what's considered the Midwest baffles me. Like, how
Jeb,
did
did you
anyone
pay
ever get there?
did you pay any attention at East Carolina University?
No, no, I
Well,
absolutely did
I am
not.
I am doubting the Kinston school system. Now
I did not.
you remember the original 13 colonies and how our great union came to be, right? It was
Yes.
all
Yeah,
along
I
the
was
eastern
in one of
seaboard.
the original 13.
So it was all along the eastern seaboard. So everything was the west. So
I get it.
California was the far west. The
I
Midwest was everything
understand
right there
that,
down the
but
Midwest.
we've come a long way since then, right?
Tradition. It's
I-
tradition.
well, we've changed all the other traditions. I think we need to change this one. We need to call it like
So
the Central America.
so hold
But we
on.
already have one of those.
I have a spectacularly dumb story to tell you guys. We used to play flag football, and we played with a guy who was insane and dumber than dirt. And we're out one night, and he was aggressively debating with everyone, much along your Midwest. He was telling us Chicago was in the Mid-East. Not the Middle East, it was the Mid-East. He's like, no, the Midwest is like Indiana. If you're over in Chicago, that's like the Mid-East. And we're like, you're out of your mind. He also would
Maybe he was
refer,
talking about it's mid east of Illinois,
maybe he also was the
but it
guy
would be
that
South Illinois.
would refer to old school Coors, not Coors Light, as the golden bullet. He was going to get some golden bullets, and I don't think that's appropriate anywhere.
Sorry, guys. We probably just lost like 20 viewers during that whole deal. All right.
Did we want to go any deeper in that, other than literally the Midwest is very
no.
affordable?
It's less expensive than the coast, right? And there's a lot of entry level homes as far as price points go in those areas. And that's where you see, a lot of people looking to purchase right now, right? Is that entry level homes. And so you've got people willing to move there. And again, it's a lot of people want to move for a change of pace too, right? It's a different quality of life, if you will. It's not the fast pace that you see in some of the bigger cities. People want that. People want more land. There's a lot of reasons that people decide to do it. And cost is one of those. And so, but even in those markets, you've seen double digit appreciation over the last year just because of what's happening.
And even like for us, it's easy to make fun of the Midwest and say like, where you want to be in Indiana, but like Wisconsin, you've got Madison. It's a great city. There are wonderful cities throughout the Midwest, and there's also terrible parts where you get really rural and it's super cold and up on the northern borders. But there are a lot of really good cities throughout the Midwest that people are stoked and excited to move and live in.
No, absolutely. Let's move on here. So I jumped down a minute ago, but I missed jumped this question, and I want to get it for Michael. On a new build, I was told I would only pay taxes on the land value. The second year, I would pay on the land and the home value. Is this true? So I know you're buying new construction in Texas, I believe. Not sure how Texas works. I think it was Texas. If that's what you're being told, that's probably accurate. Honestly, I couldn't answer that for you. Josh,
some of it depends on how quickly they build the property. Most of these builders, this is truly like an assembly line. So once they get their entitlement, like within about 3 months, that property's built. So there's not enough time for the assessor to go, oh, now there's a house on it. So when you're buying it, the assessor believes it's just land. So yeah, that first year you will, but to my knowledge, most every state goes back and says, well, yeah, it was assessed as land, but it had a house on it. So you underpaid the taxes. You owe us a supplemental tax bill for the difference. I know that's how they do it in California.
Yep.
I would suspect that's how they do it in Texas as well.
There you go. But it's a good question to ask your agent if you got one. Even if you're using the builder's agent, just get something in writing to make sure, you're being covered and you're not expecting some crazy tax bill when you close, or even after you close and it gets reassessed or what have you. So Clay Joyner's asking, considering Streamline refinance, any recommendations? So probably need a little bit more information there. But Streamline refinances, for those of you who have FHA, VA loans, Streamlines are an awesome way to take advantage of lower rates in many ways. Little documentation required, usually no appraisal required. It's great. Anything you want to add to that, Josh?
FHA and VA, so VA is technically an IRRRL, FHA is a streamline. They're very similar. No appraisal, no income docs. We have to meet a requirement of lowering your interest rate by 0.5% to be eligible for them. And the thought is that either for FHA and VA, they're guaranteeing these loans. If we can lower your monthly payment, that's better for you. Both programs were heavily getting abused by call centers that were just carpet bombing people with FHA and VA loans and tricking them into doing loans with lower payments that were not in their benefit. So we have some pretty good guardrails around them. But the important thing with an FHA loan, there's a maximum loan amount. So they're not going to let you tack in a bunch of fees in there. If it's a VA IRRRL, VA doesn't really have that same requirement. They both have a recoupment period where you have to be able to recoup the cost of a loan over a period. But VA is still a little bit susceptible to someone charging you points for a really low interest rate and increasing your loan amount. So just be very careful. To be eligible, you have to drop your rate 0.5%. For most people, if the loan's large enough, that's going to represent a pretty big monthly savings. Let's just make sure we're looking at penciling out that the savings justify the costs. And if you've been in the current loan very long, I hate someone that's paid their loan for 4 or 5, 6, 7 years, going all the way back to a 30 again, without a really, really good, compelling reason as to why that's better for them in the long run. So that would be the big advice for that. And Jeb, I don't know if you saw here, this is actually a pretty good question. I love things that are black and white. This one is not black and white. So Khalil says, my loan officer from the mortgage company told me that I should sign on my home as a second vacation home because I'm not moving until the new home is built. He says, he follows up, says, he said, the mortgage rate is the same as a 30-year conventional loan rate. He said, it's not going to be increased for a second vacation home. Is this true? So it is true that there is not a loan level price adjustment, which is an add-on with Fannie Mae or Freddie Mac for a second home. And until very recently, that was across the board. No one charged that any additional add-on for a second home. What happened about 3-4 months ago, the FHFA went to Fannie and Freddie and said, we need you to not do more than 7% of your loans to non-owner occupants. So either a second home, non-primary resident, so either an investment or a second home. So almost across the board, every lender started charging a higher premiums for investment properties and started charging a premium for a second home to make sure it's a disincentive for people to apply for those loans so that they can stay under that 7% threshold. So on the wholesale side with the broker, we're approved with 20 lenders I know of and see guidelines from 150 lenders. I don't know of any that are not charging any longer, but it's purely at their discretion. So if you're dealing with a direct lender or you have someone that has an option out there that there's no add-on for the second home, it's surely possible, but unlikely that anyone would not be charging some type of premium, even though it's not required from the government or from Fannie and Freddie at this point.
Good stuff. I'm trying to put my phone on silent here. All right. Al was saying that he watches all the videos and writes down questions as they come up, hence the Al Bundy portion of the show. Al, send me a list of those questions. Those make good videos versus just going back through this entire list. So email me. I'm sure you probably can find that online if you look hard enough. Ray wants to party at 1908 in Temecula. I feel like I missed something up here in the thread where somebody gave their address, but
wasn't this just a problem in Huntington Beach last weekend? Someone put their Instagram party. They wanted to have their party on the beach, and we had disturbing the peace and big lockdowns. I think Ray's trying to start the same thing in Temecula.
Adrian's what the hell is that thing called?
Adrian's Beach Bash, or what was it?
Adrian's
birthday kickback.
Yeah, Adrian's kickback. I wasn't here, but yeah, it was chaos. I heard. I guess I should know that, right? Since I classify myself as a millennial today, people gave me crap. But I was going from like one of the I forget what it was. One of the videos I had done previously where they had said who the buyers were. I forget where the actual data came from. And they classified millennials into two categories, younger millennials and older millennials. And I fell into the older millennial category because of when I was born. And so I referred to myself as an older millennial based on that. And people were like, dude, you're not a millennial. You were born in 80. It started in like 81 or 83. and giving me crap. And so now I'm just clarifying. Anyhow,
I give you credit for being a geriatric millennial.
there you go. I like that. So Yusuke Matsuo, looking for a property in Irvine, just realized that there is another property tax called Melrose. What is the best way to look up the tax in advance? So here in the state of California, there's something called Melrose. It's basically a tax for infrastructure when they build out these communities to parks and schools and all this good stuff. They sell bonds and essentially the people buying the properties are the ones that end up paying for that infrastructure when they buy the property. And they're usually 25, 35 years, depending on when the city built them and all that good stuff. And I know Texas has something, and I forget what they're called, but it's something similar in the way they build out infrastructure. And I'm sure other states have them as well. But to answer the question directly, you can actually search OC tax assessor in Google. It'll bring up the OC, the Orange County Tax Assessor's office, and you can type in a property address and actually view the property tax bill on any property in Orange County, quite frankly. And you can see what the Melrose tax is on that bill. It'll give you a breakdown of where the taxes are going, what the base tax rate is, what bonds, all that good stuff. Now, what it won't tell you is how long it'll be on there in most cases. That's something you're probably going to have to reach out to the listing agent, or have your agent reach out to the listing agent to find out when that Melrose goes away. But just keep that in mind, unless you have something, Josh, that I'm missing there.
No, nothing good on that other than digging up the original. All those documents are recorded. It would just take some heavy lifting on your part.
Yeah, exactly. Get your agent to do it, unless I'm your agent. And then I'm just going to call the listing agent, find out. Just kidding. Anyway, Ricky Andy Batia. Jeb, what are the pros and cons of using the listing agent as your realtor? I think the only pro is that you might get your offer accepted. You have a better opportunity to get your offer accepted in some cases, but in some cases that listing agent is representing more than just you. So it still may not be, the best way, but what are the downsides? You could end up paying more for the property than you would otherwise. You may not have an agent that's really negotiating on your behalf. They might still be really negotiating on behalf of the seller, since they were hired on behalf of the seller. It's a gray area, right? Not all states allow dual agency. California is one of those states that allows it. So the listing agent can represent both the buyer and the seller. And when I say that, if you think that's crazy, it's because it kind of is in a way. It's when you get a divorce, chances are you're not going to hire the same attorney to represent your the husband and the wife or whatever the situation is there. It's because you need a party really negotiating on your behalf that's willing to have tough conversations and to do things. And oftentimes when you're using the agent, a listing agent in that situation, you're not going to get the tough negotiations in many ways. But that it's a deep conversation, and there could be arguments on both sides of it.
The piece that I always go back to is it's as simple as this. A dual agent cannot be an agent. They can be an agent of one, which means they're actually abdicating their responsibility to the other and not being their agent, or more likely, or in best case scenario, they're a mediator. They're helping mediate the numbers between the two. I don't want a mediator representing me. I just don't care. Like there's no advantage. I mean, if you told me there was some sort of spectacular deal and that agent was only going to do it if they could double end it, maybe, but it's not a good idea being involved in a dual agency situation, unless it was absolutely the only way you could get the property and you really, really, really wanted that property.
Well, there you go. TK4C. I listed 379, offer 379, increased 3K up to 400K to beat other offers. So basically they did an escalation clause, it sounds like. So they offered 379 on a 379 purchase, said they'd pay 3,000 higher than the highest offer, up to 400,000 is the way I read that. And 10,000 over the appraisal. So that means if the appraisal only came in at 380, then they would still pay 390 in this case. Appraisal came in at 355. Which means that they could pay 365 in this case. Buyer said I had to take 365 or take me to court. Haha, they didn't want to pay 379. No deal. So you know, as a seller, you know, depending on what state you're in and what have you, it's tough to back out of situations like this. If you have a fully executed agreement, you know, the buyer could fight it in many ways, especially if you agreed to that in writing, saying that you would take 10,000 higher than the appraisal up to what, 365. You know, it depends on how it was worded in the negotiation, right? You want to be clear in those conversations to say, hey, look, if it appraises for less than the offer price, I'm still only willing to pay 10,000 higher than the appraised value. I mean, so could somebody take you to court? Potentially. You know, it just depends on, again, how it was worded and whether or not they want to fight it. So that's really what it comes down to more than anything else is how much do you want to fight it? Are you willing to pay somebody money to, you know, to go to court and all that good stuff?
I got a good one here, Jeb.
All right, let's hear it.
So Kevin W. with his Tesla with the headlights on says, I'm closing in 2 days, but I haven't seen my final closing disclosure or scheduled a notary appointment. Is this normal these days? Large question here. Is it a refi or is it a purchase? On a purchase, we have a scheduled closing. So I can say one of the reasons why I've been a little bit distracted tonight is we have several clients that are supposed to close on Friday. So here we are Wednesday night, and we have a bunch of them signing, getting docs out, all that fun stuff. And that's not ideal. We would have liked to have had docs out last week, but we had a holiday, all of this fun stuff. Everyone is still really busy. Agents are getting more aggressive at writing shorter escrows. Everything is 30 days. A lot of them 25, 21, 17-day escrows. So if it's a purchase, hopefully they're doing everything that they can. The final closing disclosure, it tells me that you have, because for those of you that don't know, the closing disclosure, you cannot sign your loan docs until 3 days have passed since you've seen and acknowledged your closing disclosure. If he's saying a final closing disclosure, there can be an updated one that goes out after that. So hopefully there's not much changing from it, and it will come out and you'll be able to review it. What we always like to do before the borrower signs is get a copy of the estimate from escrow. The closing disclosure is great, but it's always important to remember that what that document is, it's a CYA document for the lender. The government said, hey, lender, you have to be accurate to within these tolerances. There's a final CD at closing that will be dead on accurate, but prior to that, you'll still see things over disclosed to protect the lender. So what we really want to rely heavily on is escrow's estimated settlement statement, and that document gets better all the way through the process right up to closing. Once they get the loan documents, they're going to get you the most accurate number. But it sounds like, if you haven't heard from notary, docs aren't at escrow, and we're still not to that point. But I wouldn't say it's normal, but timelines are tight. There's a lot of loans still being done, even though not as busy as last year, and tight timelines on our purchases.
All right. Good stuff. Michael Duree, will our new build ever be worth less than what we paid to have it built? I hope not. So, you know, I mean, could it in theory? Sure, it could, but less likely. You know, if you're, you know, again, you're buying new construction. I don't know if you're paying to personally have it built or if you're buying it from a builder to and they're, you know, doing all that good stuff. But it's hard to say, right? Yes, I mean the answer is yes, it could be, but you know, depending on what you paid for it and all of that good stuff, and you know, how that area is developing and what happens over the next couple of years could dictate that in a little bit. You know, give you some more clarity, but I don't know, Josh, anything you want to add on that one?
No, it's it's in the hands of the gods at that point. Anything is possible. It's highly unlikely because we're looking at, you know, several years of appreciation ahead of us. But at some point, we will give a little bit of it back. It's cyclical. We talked about it probably a month ago, the last time I was on here, that it used to be we had a few cyclical markets: Southern California, Bay Area, Boston, New York City, and now it seems like more and more markets are cyclical. Information spreads faster and easier with the internet, and people are more interested. We got HGTV. Everyone loves real estate, buying, fixing up homes. I think we will see more nationwide cycles. Before 2008, one of the things that everyone liked to rely on is home prices have never dropped on a year-over-year basis nationwide. And well, who gives a shit? You just took, a bunch of areas that don't change and said, see, it's never changed. All I care about is my area. So I think we're going to see more of that cyclical nature, that over time we'll have big run-ups and bigger drawdowns, but not likely to happen in the near future.
All right, we got a couple questions here that aren't normal questions that we get, so we're going to answer them. We're going to give Aru T. Here comes a not so serious question. What do you think of luxury vinyl plank versus real hardwood in terms of resale value? So I think, honestly, resale value, I don't know that it really makes a difference. I mean, I think that it's really going to depend on what the buyer wants, right? I think if you're in a high-end luxury home, you're probably going to want to see real hardwood in a property, right? I mean, typically speaking, it's a level of what you're purchasing and that sort of thing. But in most properties right now, the luxury vinyl is. I mean, I have it in my house.
I'm putting it in the property in orange.
Yeah, it looks great. I mean, honestly, and we actually just put it all the way up the stairs because my kids have ruined the carpet up the stairs, and you can't tell. I mean, a lot of people can't tell at all. I can tell just because I see it all the time, but it's come so far. It's waterproof. It's great. But I don't really think it affects the resale. I mean, it just really depends on what the buyer looking to buy your property is looking for in a home. And I would say the majority of people have no idea what they're looking at to start with. So,
well, I'll say this. I was watching one of the HGTV shows last night, the girls that do unsellable homes. They're up in the Pacific Northwest. And it was funny. Like, they were talking about, oh, we just don't have money in the budget for hardwood on this one. We're going to have to do the LVP. And I'm like, why are you even complaining? It's way less cost. Mm-hmm. Buyers cannot tell without getting down and feeling it. Like, they are so good with this stuff. Like yours, I would bet 80% of the people that come to your house have no idea that's vinyl and not wood. And that's why we're putting it in the place in orange. It looks fantastic. It's more durable. It's cheaper to replace. If something happens and your kids drop a curling iron and burn the floor, torch it, cool, we pull that piece out, we put a new one in. Like, until I have an estate that's, you don't want to base it off of prices, but for us in our market, until I have a $3.5–4 million house, I wouldn't even consider wood. It's LVP all day.
Yeah, and it doesn't. I mean, they say you can't scratch it. You can scratch it. My kids have managed to do that. But it's a lot better than scratching hardwood and that sort of thing. And honestly, you can't see it unless you're at certain angles. But again, to answer the question, I think you're no real issues either way with whatever you decide. But I would say that the LVF is good stuff.
If it's like LVP. If your home is double what the median price is in your area, you can start considering hardwood. If not, I wouldn't even think about it.
There you go. Let's see here. Eddie Espinoza, are there any hidden issues or costs that I should consider if taking closing assistance on an FHA besides a higher rate? So considering an FHA loan, sounds like maybe there's a down payment assistance, maybe is what I'm thinking. So any hidden issues there, Josh, or additional cost?
I have a huge bias in that we're in California. California has almost no assistance programs other than Cal HFA. And the big giant monster drawback to Cal HFA is about 18 months ago, they stopped cooperating with subordinations. So the way they structure it, they're not giving you money. It's not a grant. It's down payment assistance in the form of a second and most times a third mortgage on the property. You don't make payments on them, and they have very little or no interest. So most people are like, hey, no big deal. I get in the property. The downside is you have a second and a third mortgage on the property. So unless the property appreciates, which everyone's going to go, hey, no problem. All of the homes have gone up a ton over the last 12 months. Unless you're in a rapidly appreciating market, it could be 3, 4, 5 years before you can refinance, because Cal HFA would not subordinate their second and third mortgage to your new first mortgage. So we had people who were unable to refinance when rates were 1.5% lower than what they were in because the property hadn't appreciated enough. So it's a strange and weird use case. In general, what I would also say is 99% of loans that are done are lender paid, meaning you do not pay your broker, you don't pay the lender. They're either making their money by selling the loan in the secondary market or by the wholesale lender that they give it to. Most down payment assistance programs are not done that way, and you actually end up paying your lender out of your assistance fund. So it ends up being a more expensive loan, generally doesn't have as good of terms. What I want to do at a minimum, I'm not saying we never do Cal HFA loans, we do a few of them here and there. I always want to pencil out the numbers and show someone side by side what the difference is. We have a viewer here that's in California, they're out somewhere in the Inland Empire, and they called and specifically asked for a Cal HFA loan. And I went through it and I showed them the numbers side by side. They may have to go Cal HFA because they can't come up with their down payment, but I always want to show them, what does it look like if we get you a big enough lender credit to cover all your costs, all your prepaids, and you just come in with your down payment versus that Cal HFA loan. Now, if you're in another state, I do know for a fact that some other states, Texas has a lot of down payment assistance programs. A lot of the states through the South, Georgia, Florida, North Carolina, they have more and better assistance programs. So don't take what I just said as gospel if you're outside of the state of California, because there are some that are better. I would just seriously ask your lender and say, are there any significant drawbacks to this program? What's the downside? Is it a second mortgage? Is it a real grant? You know, I think one of the other questions we had here was someone asking about the B of A down payment assistance program, which is a true grant. So if it's not a grant and it's tied to your home as a second and or a third mortgage, I would think seriously about it and just always get a side-by-side comparison of what it looks like with a standard FHA or 3% down conventional loan.
All right, so there's two questions here that are going to be pretty easy to answer. One is going to be this one. So Perlita, I can't even say that. It's like
Perlita. That's
okay.
Little Pearl.
Yeah. Perlita. There you go. Do streamlines allow you to get rid of the FHA insurance if you've gained enough equity? No. So that was that one. And Anderson here, why do mortgage companies sell the mortgage, Josh? Get a new loan and you find out 3 months later you got a new company to pay.
So the way loans are done is there's just a handful of entities big enough in this country to truly want to own a giant portfolio of mortgages. What they want is the origination income. So, hey, I generated this pool of 1,000 loans that's $2 billion. Now I want to sell it because that's an asset and I want to make my profit. So they're really in the business to originate. They're not in the business to hold and own. And there's two pieces which a lot of people don't know. A lot of times they say, oh, my loan got sold. Didn't get sold. The servicing got sold. The same person owns your loan, but they decided, hey, I don't like paying servicer A. I can do it cheaper with servicer B. So magically one day you have a new servicer, but your loan wasn't sold. But the biggest reason is most participants in the mortgage industry are looking to make money from originating the loans, which requires selling those loans to ring the cash register.
All right. Good stuff. Couple here. This is going to be a little trickier one. I'm going to come back to it in just a second. But Ashok Shalini, is it a good time to buy a home in Louisville or wait for one more year? I would say chances are, I mean, I don't know the Louisville market well. Louisville. Well, but if I think there's a good chance that property values are probably going to be higher there next year as well. So I wouldn't think anything is really going to change in the next year in most housing markets. But it's tough to say. I wouldn't say that you would see a drop significant enough to really make a big difference. So if you're in a position to do it now, you're comfortable doing it, I would tell you why wait. But here's a good question, Josh. So Mike Rev, can you comment on single unit approval for FHA condos? How do you find a mortgage lender that will put in the work?
So if you're going to a direct lender, it's just their policy. Do they do it or do they not do it? From our end, as a broker that deals with multiple wholesale lenders, the majority don't. They don't want to get involved in it. They've had enough loans that they don't want to have a department responsible for that. So 20% of our lenders will offer it. I would say check with the broker and see if they've gone through the process before, and have them check with the lender that they're going to place your loan with and make sure that they're experienced in it and able to do it. And there's another alternative. Jeb and I had a client a few years back that we had to get a complex here in Huntington Beach, VA approved. Yeah. So it wasn't VA approved. So they agreed to do it FHA. We closed the loan. We took the time to get it VA approved, the entire complex, which isn't all that time consuming or expensive. It just took a little bit longer than we had in escrow and the seller wasn't willing to wait. but you can get the entire complex approved. It's not all that expensive. And we do the same thing with FHA. I don't know what the turn times are right now. I would say they're probably a little bit longer than what your escrow period is. That's the benefit of the one-off single unit approval. But I would say, even if it was on my dime, if I was buying in a non-FHA approved complex, I would like to have the complex approved, because it just helps resale value so much if you're in that price range.
All right. Yeah, no, good stuff. I'm reading questions here. Sorry. Salva Truch, great channel. Thanks for the hard work. Appreciate you guys watching. Again, if you find value in this, hit that like button. I appreciate you guys being here. We were off for a couple of weeks. We'll try to be a little bit more consistent now and get back on our weekly kick. Let's see here.
Michael Dury just asked the same question my wife asked me last night. We're putting a pool in. We were hoping to have it in by summer. It's probably going to be, because of all my surgery and all that fun stuff, it's going to be later on in the year. And we were just reviewing the numbers last night. And no, the answer is no. You're not going to get that back out for the pool. So you have to decide, how much am I going to enjoy the pool? I'm paying for entertainment. Right. So when I looked at it, the numbers, it's probably $100,000 more than would be justified in terms of added value, but we're doing a bunch of extra crap that will also add some additional value above and beyond the pool. But most importantly, I can't move. We're not going to go into the depths of Prop 13 and the new Prop 19 here in California, but I can't move out of my house for 7 more years. So I want to enjoy that house as much as possible for the next 7 years. So we're going to dial that thing in. It will be the most expensive home in the neighborhood, and you could argue that it's slightly overbuilt, but it is what it is.
Yeah, no, I mean, and to follow up to Josh's question, you add it really did. Josh just went blank on us. I think his video died. So we're going to go off Josh here and just on me for a minute while we actually can't do that because Josh, let's see here. There we go. If it costs you $70,000 or so to build a pool, it's probably going to add $25,000 maybe to the value of your home. So you'll get about a third of what it costs you to build it. But the key is, like during the pandemic this last year, during COVID, people wanted homes with pools. And so they were a commodity. So people, because of entertainment and what have you, so people were willing not necessarily pay for the pool per se, but buy houses that had pools. They wanted them because of what was going on. So you just got to find the right buyer that's willing to pay for it. Now, chances are you're not going to get dollar for dollar of what it costs to build the pool, but over time, the property is going to increase in value, which makes having that pool, more sense. But you probably would have gained the equity either way. We'll find Josh back here in just a minute. I don't even know if he realizes he's gone. Maybe he's still talking over there. Let's get some more questions here.
Look at this guy back in business. I took your side.
All right. I didn't even realize we were on the other side. All right. Question here. Basil, I signed the closing disclosure yesterday. Does that mean the underwriter has seen my file, or does he look at it only after my finance is still the same? So signing the closing disclosure, what does that mean?
The closing disclosure will never go out until your loan is approved. Different lenders have different requirements. Some of them require the appraisal to be in and the loan to be approved, but the underwriter has absolutely seen and approved your file if you're seeing a closing disclosure. So we used to have, back in the day, the good faith estimate, and it was sort of like, hey, I hope that the loan officer knows what they're doing and is being honest with me. And now we actually have laws that say within 3 days of your loan application, you have to have a loan estimate. The different blocks of the loan estimate can only vary so much between there and your closing disclosure. Very similar document, looks very similar, but the closing disclosure comes at the end, where we're just confirming those were the costs, the things that can change within the acceptable tolerances. And you have to be able to see and review that at least 3 days prior to signing your loan documents.
All right. And so does that mean I got the home? No, not yet. Nothing is done until it's done. But it does mean you're one step closer. So you should be good as long as nothing changes on that front. Mr. ABS, how willing are the builders to go against a floor plan, like adding a closet to a room not shown with one, or even slightly expanding a closet in one that looks smaller on the floor plan? So I don't really have any experience in builders doing this, but I can tell you everything has a price and people are willing to do things for the right amount of money. I'm familiar with actually a property here in Huntington Beach in Brightwater that when it was built, they wanted an additional room off the back of it and they paid for it and it was done. And the builder actually did it. Now, depending on the situation, how many homes they're building, all that good stuff, you may or may not get the builder to do it. But chances are it would come with a cost if you're going to do that. Anything to add there, Josh?
No, pretty much the same. But I do have the most important question, and this timing couldn't be better because my wife and I were actually discussing this morning. Any thoughts on Boca Raton? And I'd had this thought this morning, and I have no idea why it came up. Something while we were driving around brought this up, and I said, Angela, do you know that the beautiful name of Boca Raton, Florida, means rat mouth? It's rat mouth, Florida. And that's all I think about Boca Raton. I'm sure it's lovely, and all of Florida is doing very well. And the demographics for Florida are solid. So I wouldn't hesitate to live there, other than the fact that I would always be thinking that I live in rat mouth.
You could look at it that way. What I will say is it's hot as bejesus down there. It is, just ridiculously humid. But outside of that, we don't know the markets well enough to really give you any insight on those. But I know it's a beautiful area. I know agents that live there, so or work that area. So if you need anybody, let me know. I saw a question up here a minute ago. It was directed to me, and I want to get to it real quick.
See if you can. Yeah, go ahead.
Yeah. So JC asked, in Orange County, California, that's the market that we're in, halfway in between LA and San Diego. For those of you not familiar, our single family sales still 50% cash, 50% finance. So I've never seen that they were 50% cash. I expect that number to be way higher than what the numbers actually are. I would say that. This is merely a guess because I don't know what the numbers are, but I would say that's probably 10, 15% maybe cash. I haven't done, an all cash purchase with a buyer in quite some time. I've had one in the last year or so. They happen, but you're talking. There's thousands of sales happening. I just don't think it's 50%. But Josh, how many? Well, you wouldn't see cash purchases, would you?
We don't see cash.
Yeah.
And you talk to more. I talk to a lot of agents. You talk to more than I do. But I would just say, I think that nationwide number is shocking at 25%.
Yeah, agreed.
And part of my brain says, well, it would be higher here because we're in a really high-end wealthy area, but home prices are much higher. It's harder to roll in with cash. It does happen, but I would bet you're right. It's probably in that 10 to 15% range just because our home prices are so high. That's a chunk of money to come in and pay all cash. It happens. I would say it's less common than those nationwide figures.
Dude, can I just point out that Nightbot just gave Blake Johnson the justice delivered stop spamming symbols warning down at the bottom? That's why I don't even know what Blake Johnson wrote.
Nightbot came in strong and said, I'm not having it though.
No, not even strong, but just said justice delivered. That is, and Jennifer's over there just taking care of business too. So it's all good. Let's see here. So
I got a good one.
Well, I like Ricky first. Hold on. Ricky said he likes the Duo live stream. Thanks for taking the time to answer the questions and share knowledge. So thanks, Ricky. All right. Get yours there.
So the loan officer at YYAN says, if the loan officer asks the buyer to get home insurance quote, does this mean the loan officer just wants you to do some of the dirty work? And I would say absolutely not. So we always ask our clients, I say, would you like us to get you an insurance quote, or do you have someone that you want to work with, or do it yourself? What I would say is they're probably don't want to have an appearance of a conflict, or that they say, hey, I got my buddy does insurance and I'm going to send you over here and get you a quote. I have a broker that I've worked with for a long time that's awesome, and I would love if all my clients said yes. And then what I do is I take the information over to them, and I know they're going to get a really competitive quote, and they're going to get us exactly what we need in a timely manner. That's why I prefer it. I don't get a kickback. I know he's going to do a good job and get us everything we need. Now, on the flip side, I would say less than 20% of our clients take us up on that because they have car insurance, so they have an insurance person they're dealing with, so they want to bundle it, they want to keep it there, or they want to shop it themselves, or the non-geriatric millennials like Mr. Jeb. The younger millennials love Lemonade and all of these online apps so that they can punch in some buttons and not talk to anyone and get a really low insurance quote. So for that reason, we don't ever want you to feel like we're trying to push you in any direction or we have any affiliation or profit motive. But I'm more than happy to do it for you. It's just most people don't want it.
No, I understood. So one question, then we're going to talk rates. We've kind of skipped over that somehow. So Julia is asking, wondering if you're going to touch on forbearance exit. So right now, still getting data out on forbearances, right? I mean, you don't really know when people are going to fully exit forbearance, just because it's been extended a couple of times. Could it be extended again? I mean, hell, it could be. I would think that we've probably reached the end of the extensions, at least on the forbearance side. I think, evictions and foreclosures are set to expire the end of this month in June, for most of the United States. I could see that extending. We're going to know here real soon whether that gets extended. It could be extended for another 3 months or so, but it's hard to say what happens there. But forbearance, numbers, I'm actually going to do a video and talk about it. I've been reading a lot about it lately, are still trending downward, right? So the people exiting forbearance are going down. The majority of people exiting forbearance are performing on their loans, are paying their loans. They're being offered crazy terms with regards to modifications and what have you in order to keep their payments low so that they can continue to make these payments. I mean, I've actually had a couple people reach out to me talking about partial claims and what their lender's offering them and all of this stuff. And it's crazy, some of the stuff that people are getting with their payments going lower. So I think, again, my personal belief, but I think a lot of people that are exiting are going to be in a position to repay their mortgage. And if they're not, they're in a position where they have enough equity because of what's happened over the last year and a half. And even prior to that, if they've owned their homes, where they're in a position to sell their homes and not be in a position of foreclosure. Now, the flip side of that is you do have some areas, FHA loans, VA loans are two of the categories where they have the majority of people on forbearance. If those people are in a position where they, depending on how many payments they made, depending on what the appreciation was in those areas, they're more likely to be in a position where foreclosure would happen. But I think even those people, if they're willing to make the conversation, make the call to their lender, the CFPB came out and basically told these servicers, you need to figure this out. And so I think a lot of these people, maybe even if, the problem is a lot of people don't understand that they have options, and they're just going to roll it out and not do anything. And those are the people that are going to be affected the most. But I don't expect to see anything crazy happen with forbearance ending. Josh, if you want to add to that, otherwise, let's talk rates.
Well, hey, I'll add a brief coda to that. That lenders learned a lot from what they did in 2008, 2009, 2010. They made it worse for themselves. They said, nope, we're not helping anyone. That's moral hazard. Screw them. They need to make their payments. And it made it worse for themselves. So the folks I'm buying the property from in Orange haven't made a payment in over a year. They didn't take on forbearance. They're literally just behind by 12 months on their payments. That lender reached out to them with a very aggressive modification offer, and it just didn't work for them. They have one person that wants out. They just want their equity and to move on. One of the three owners, and that's where we're at. So I do expect soft landings for the vast majority of people, just because it's better for the lender to work with people. So for that reason, I don't expect a big concern or anything about it. Now, in terms of interest rates, moving on to that fun little topic, it's interesting. I get so many newsletters of different people. One of our wholesale lenders, who happens to be the biggest wholesale lender in the country, their CEO did an update yesterday, and as part of his update, he told us how their economists believe interest rates are going to trend higher and what that's going to mean. Got another one here. I forget who it was quoting, but it was the MBA. Someone just saying, hey, interest rates are going to be 3.3 to 3.6 by the end of the year. So still excellent, but trending higher. And yet here we are in June, and your 30-year fixed with 0 points for your well-qualified buyers is right at 3%. Most of the loans we've locked in the last couple of weeks have been under that, 2.875, 2.99. So if you and I flash back to late November, early December, people ask, well, what's going to happen next year? We said it's going to be more of the same. Your best case is probably 2.625. Your worst case is probably about 3.375. And the worst case that we've seen all year is 3.375, and it's moderated right back to the middle of that range. Long run, rates are going to go lower. That doesn't mean next week, next month, next year, 6 months from now, but in 24 months, in 48 months, rates will be lower than where they are right now. We're not going to go into all the details of that, but I always like pictures. Pictures are worth 1,000 words. So I wanted to see, here's a window. So this chart right here, look, we made me and Jeb tiny. This is the 10-year treasury. And why it's kind of important to show this is, can't see the dates on here, but this was that big downturn through February. So this is bond prices, 10-year treasury bond prices going way down and yields going up, or mortgage interest rates going up. We bottomed here in March and made a nice run up, and then they went back down, back up, back down, back up, back down. So this range here shows you that interest rates are range bound. For the last couple, 2-3 months, we've gone nowhere. We're already in June. So yeah, 90 days, we've pretty much gone nowhere. The other picture I wanted to show is this is actual mortgage-backed securities. And Jeb, what's this beautiful little formation here called?
Triangle.
That's a pennant formation that we have. I didn't draw the flagpole so that you could see it. But our highest level here, so these, again, we want to see these green candles and these prices going higher. So we have this downtrend line and we have this uptrend line here. And what generally tells us is we're going to get a breakout here at some point. So rates are going to get worse or they're going to get better. And everyone loves to go to the, well, they got to get worse, because even if they get worse, they're still amazing. And COVID's over, so rates have to go up. Well, generally, when you get a breakout, it's in the trend of the prior direction. So if we drew this channel and took this green line all the way back here and drew a top of the channel, I'd say 65-70% chance we break out to the high side and rates get a little better. Not going to be a ton better, but keeping us under 3% for the best qualified conventional borrowers, and in that 2.5 range for the best qualified FHA and VA buyers. And jumbo buyers are right in that 3%, low 3% range as well for 0 point no lender fee loans. So big picture, what do we have? So normally we would have had the ADP monthly employment report come out today. It's delayed one day because of Memorial Day. And then we're going to have the Bureau of Labor Statistics follow up on Friday. So if either of those disappoint, it could be the impetus to push us out of the top of that range and to better rates. If they came in super hot, last month we were expecting 600,000 and we got what, like it was like 200,000, 150,000 jobs. Right. It was horrific. This month they're expecting 600 for both of them again. And short of like 1 million jobs coming in, I don't see anything being bad for interest rates. Someday we'll take 20 or 30 minutes on here and go through the myriad reasons of why rates cannot and will not go higher. But for now, it's enough to say that we're likely to see a lot of what we've already seen, which is really good rates, really supportive. We probably don't want rates going a bunch lower. Most people that wanted and needed to refinance already have. And for buyers, we don't want rates going to 2.5 and just giving people more fuel to push prices higher. I'm happy to see interest rates sort of in this Goldilocks level for right now, but you flash forward 2, 3, 4, 5 years, we're going to be lower than where we are right now. So just make your plans accordingly. Don't pay points, don't pay a bunch of fees for your interest rates. Anything can happen in the interim. We are going to see hot inflation numbers for the next couple of months, but flash forward a year and they're going to normalize. As supply chains normalize, we see some of the commodity speculation moderate, and the bigger picture long-term demographics take effect. And you see there's just a number of things, and the biggest of those is the volume of debt the U.S. government has taken on. It just weighs on the economy. It lowers growth. When you have low growth, you don't have inflation and you don't have high interest rates.
All right, there you guys go. You always want to know about rates. We discuss them every week, but there's the latest from Josh. So we're going to answer a couple of questions here. We're pushing on 2 hours. Blake finally got his question answered, and he's bummed we called him a spammer. So, sorry.
Naybot went vigilante on him.
Yeah, just did him in. But he's got a question. Living in Louisiana, wants to buy his first duplex. So start somebody called me yesterday, wants to buy an investment property, and wanted to know if I, know of any investment properties locally, blah, blah, blah. We had a conversation, and I'll tell you the same thing. The very first thing you need to do is talk to a mortgage professional, find out how much you can get approved for. And then, that assuming that mortgage professional knows what they're talking about, they can probably give you an idea of what rates or what rents would be on the other unit of a duplex, assuming you're buying it as an investment property, or a primary and renting out the other one. Maybe you're buying it as a duplex. Well, it's your first property. So chances are you're probably buying it and living in one and renting out the other, but you need to, figure out how much you can qualify, and see, how much it's going to cost you to own that property, right? I mean, how much, rent is the other unit going to bring in, because the lender's only going to give you 75% of that in order to help you qualify. So there's a lot of questions there. Everybody just wants to own investment property, but you need to start with having that conversation with a lender, because, you need to find out how much the down payment is. Are you comfortable with the payment? All of that good stuff. Outside of that, I don't think there's a question, but
and I would just say, we get this question probably every other week, and I would say it's the smartest thing you could do. If I could go back in time, the first property I bought was a very affordable condo, and we kept that for a rental. We ended up eventually selling it, but I would absolutely buy owner occupied units. It's never cheaper or easier to buy units than when you don't own anything. So you can go FHA, you can get in for very little money. You can do duplex 3.5%, get a lender or seller credit for all your closing costs. And generally the rents from the other side are going to make it much easier for you to own and live in your side than it would be to buy a single family, or definitely than a condo. It's really one of the best things you can do. Live in it for 3 to 5 years, build up some equity. And by the time you get married and ready to start a family, you have a nice little income property, and then move on to an owner occupied primary residence.
There you go. One of the last questions we're going to answer here, Engine Dimaril. What do you think of discount brokers or broker rebates? I know the market really well, and have negotiated with a realtor who's willing to take $4,500 and pass on the rest of my commission. I think that realtor's an idiot, and likely not a professional, and doesn't value their expertise. That's my take on that.
So, Jeb, here's this one.
Yeah.
If your realtor can't win a negotiation with you, do you trust them negotiating for you? I don't.
Yeah, no, I mean, the reality is, anybody, I get asked all the time, will you give me a kickback on no, I'm not going to give you, no, I'm not going to do it. Well, I have a realtor that will. Okay, great. There's plenty of realtors that will. But I value my expertise. I value my professionalism. Granted, I give a lot of it away for free here on YouTube. But it's not, there's a lot more that goes into it than just, everybody just sees that realtors make dollar signs. They don't see all of the work that goes in the back end of doing these transactions, and what's required, and all the expenses that we have to pay, right? I mean, we're 1099 employees. We're not W-2'd employees. So we still have to pay taxes. We still have to do all of this other stuff, and there's liability involved. So
the two biggest things, yeah.
So
Nightbot's aggressive on Blake.
So who wants to dance? This is great.
I think Nightbot doesn't like emojis for whatever reason.
I have it turned on. Like, if you do a bunch of repeat stuff, it just comes after you. And quite frankly, I think it's hilarious.
I don't think it dislikes Blake. It dislikes emojis, and Blake just happens to be the emoji user.
Yeah, you're getting hammered over there. But anyway, final parting words, Josh. Let's add some contact information here. Shall we?
Yeah, get the contact info up. If you have questions, anything we can help with, reach out.
There you go. Yeah, go ahead.
If you're in California, we can help you directly with the financing. If you're outside, Jeb and I have a big network of contacts, both real estate and mortgage. But we're definitely here for you. And I don't know. We answer a lot of questions and give a lot of feedback. Some of the things, when it's outside of the state, some of the things are state and local specific, so it's really hard to give you a great answer. But for the vast majority, 80-90% of this is consistent from state to state, and we can give you some pretty solid input.
Yeah, no, for sure. I mean, most of you know that, I don't think you know how much time is spent talking and returning emails and this sort of thing. Hours a week. It's not minutes, it's hours that are spent replying to video and messages and emails and what have you. So if you have questions, submit them. Just be patient on a response. But as always, I appreciate you guys taking the time to watch. I appreciate all the support. If you haven't done so already, hit the like button. And we will be back next week live at Wednesday at 5 o'clock. And if you have a video topic, put it in the comment. All right, guys. See you soon. Adios.